Welcome back to the deep dive. Imagine building a mathematically flawless trading indicator.
Right.
Like it's logically superior, it's perfectly constructed, and it's published by one of the greatest financial minds alive.
Ian Martin.
Exactly. So you backtest it, and it predicts long-term market volatility better than anything else on the street.
Yeah, but then you hand it to a systematic trading desk and tell them to go make money with it.
And it fails completely.
Utterly, completely.
Yeah. Today, we are looking at exactly why that happens. Because, okay, let's unpack this. We are officially kicking off episode 1 of a brand new 3-part series today called The Option Surface, VIX, SVIX, and the Limits of Prediction.
Which is going to be a fun one.
It really is. And for this first episode, we're basically staging a massive, comprehensive horse race based on a really rigorous 29-year quantitative study of S&P 500 options data.
Right. So in one lane, you've got the traditional VIX, which is the market's standard fear gauge. It's, a slightly clunky formula from the 1990s.
Yeah.
And in the other lane, you have SVIX.
The challenger.
Right. The newer, mathematically elegant alternative created by Ian Martin. And look, I want to be clear up front. Ian Martin is, without question, one of the finest financial economists working today.
Absolutely.
His theoretical framework for SVIX is mathematically flawless. But what we are setting out to do here is to separate that pristine academic theory from the incredibly messy, capital-constrained reality of actual trading.
Because the market just has a funny way of ignoring elegant math if that math doesn't fit into the operational plumbing of a portfolio.
Exactly. The core question is whether a brilliant formula actually helps you generate better returns, or forecast volatility more accurately, or build a more resilient portfolio.
Right. And just to give you a quick spoiler for where we're heading today, the punchline of this horse race is that the traditional VIX is actually sufficient for almost everyone.
Yeah.
But the journey to that conclusion is way more interesting than you might expect. So to really understand this horse race, we first have to talk about the track.
The construct.
Right. Because the researchers behind our source material, they refused to just log into a terminal and download the historical data for VIX and SVIX.
Which would have been the easy way out.
Oh, for sure. Instead, they built both of these indices entirely from scratch. And, why go through the agony of reconstructing them from the ground up?
Well, if you want to run a true, undeniable horse race, the track conditions must be identical.
Right.
If you just download the historical indices from a provider, you introduce all these tiny discrepancies, like maybe the exchange changed how they calculated interest rates in 2004.
Or a data snapshot was taken at 3:45 p.m. one day and 4:0 p.m. the next.
Exactly. So by building them from scratch, the researchers guaranteed a perfectly clean sandbox. They used 29 years of daily S&P 500 index option prices from OptionMetrics.
Which is just a staggering amount of data.
Yeah, January 1996 all the way through August 2025.
That is 7,453 trading days.
Yep.
That track covers the dot-com bust, the mid-2000s calm, the entire 2008 global financial crisis, the COVID crash, and the 2022 bear market.
All of it. And by using the exact same options on the exact same day with the exact same forward prices, they isolated the one and only variable that actually matters here.
The weighting formula itself.
Right. And the divergence between these formulas is actually fascinating.
Walk us through it.
So the traditional VIX uses a weighting formula based on 1 over the strike price squared.
1 over K squared.
Exactly. Simply put, the formula divides by the square of the strike price. So mathematically, the lower the strike price, the larger the resulting fraction.
Meaning it gets exponentially more weight in the calculation.
Right. So deep out of the money put options, which is the structural crash insurance investors buy when they are terrified of a market collapse, they get an enormous amount of weight.
Oh, okay.
A put option down at a strike price of 3,000 gets 4 times the weight of an option at a strike of 6,000. It is just hypersensitive to the left tail of the distribution.
So it's like having a microphone pointed directly at the market's panic button.
That is a great analogy. It amplifies fear.
But SVIX operates on a totally different philosophy, right?
Completely different. SVIX uses the exact same option prices, but it weights them by 1 over the forward price squared.
1 over F squared.
Right. And because the forward price is a constant number for any given maturity date, every single option strike gets the exact same weight.
Okay, so if VIX is a microphone pointed at the panic button, SVIX is like a microphone suspended in the middle of the room, just recording the entire option surface evenly.
Exactly. It captures the variance without obsessing over the left tail. And academic theory suggests that this uniform average is fundamentally superior.
Makes sense on paper, but before running the predictive tests, how do we know their scratch-built sandbox was accurate?
They validated it rigorously. They checked their self-built VIX against the official CBOE VIX and achieved a 99.8% daily correlation over more than 7,200 overlapping days.
Wow. Okay, so it's basically a perfect match.
Yeah, and they did the same for their self-built SVIX against Ian Martin's published data and hit a 99.9% correlation.
Okay, so the math is flawless, the track is set. Any difference in performance moving forward is purely because of that 1 over k squared versus flat weighting formula.
Purely the formula.
So what happens when we actually run them side by side in the real world? Because I want to drop a number here that honestly stopped me in my tracks.
Let's hear it.
At a 30-day maturity, VIX and SVIX have a daily correlation of 0.998.
Yeah, let that sink in. They move in near perfect lockstep.
It's wild.
If you look at the rolling one-year correlation, it never drops below 0.95 at any maturity. The data breaks this down by decade, the 90s, the 2000s, the 2010s, the 2020s. The alignment is near identical across every single market regime. Whether the market is grinding higher in 2017 or just collapsing in 2008, the relationship simply doesn't drift.
But wait, I'm getting stuck on this. If the entire point of SVIX is that it fixes this massive mathematical distortion, if it stops obsessing over the left tail panic button, why does it move in 99.8% lockstep with the VIX at 30 days?
Well, the bulk of the variance in the market is found in the at-the-money options. Since both formulas capture that central mass of data, they are going to track each other closely. The real question is whether that tiny 0.2% divergence holds a superior signal for actually predicting where the S&P 500 is going.
Right, because if two things are 99.8% correlated, that remaining 0.2% has to contain an extraordinary amount of signal to matter.
Exactly. So the researchers ran predictive regressions to forecast future excess returns, and they matched the forecast horizons to the signal maturities.
Meaning a 21-day forecast for a 30-day signal, 126 days for a 180-day signal, and so on.
Right.
So if I'm holding SVIX, which is a mathematically superior representation of the whole option surface, shouldn't that wider net catch more predictive signal?
You would assume a cleaner mathematical model yields a cleaner prediction, but the out-of-sample data points in a completely different direction. VIX actually beats SVIX as a standalone return predictor at almost every horizon.
Wait, really? The clunky 90s formula wins.
It wins 4 out of the 5 horizons tested. Yeah. At 126 days out, VIX alone hits a 5.65% out-of-sample R-squared for predicting returns. SVIX only manages 4.34%.
Okay, we should definitely translate what a 5.65% R-squared actually means for you as a listener, especially if you're trying to understand institutional trading.
Go ahead.
It means the VIX is explaining about 5.6% of the variance in future market returns. Now, if you were a physicist, explaining 5% of a phenomenon would be a miserable failure.
Right, they'd laugh at you.
Exactly. But in quantitative finance, where the signal-to-noise ratio is microscopic, a 5% predictive edge is a legitimate tradable tilt. It's literally the difference between a coin flip and the house edge at a casino.
And SVIX basically fails to capture that edge. Like at the short end, at 30 days, VIX edges it out slightly out of sample, 0.43%, to SVIX's 0.39%.
Which are both essentially statistical dust.
Exactly. If you take a joint model that includes SVIX to a risk manager and try to claim you have a predictive edge at 30 days, they will laugh you out of the room.
Because the signal is indistinguishable from random luck.
Right. Adding SVIX doesn't reliably improve your ability to forecast the S&P 500 returns. In joint models, it's rarely significant once you apply robust standard errors.
So key takeaway for predicting returns. The traditional VIX is at least as good as the mathematically elegant SVIX, and usually better.
Spot on.
Okay, so if SVIX is dead weight for predicting market returns, you might look at this and conclude it was just a failed academic exercise.
But
Right, here's where it gets really interesting. This is the twist. Because the pattern breaks when we shift from predicting market returns to forecasting future volatility.
And this is the one genuine finding of episode 1 that completely validates the theoretical architecture behind SVIX.
Call me about it.
Okay, look at short-term volatility forecasting, like 21 trading days. VIX and SVIX are functionally identical. Out of sample, they both hover around a 36% R-squared. SVIX adds nothing at the short end.
Which tracks with what we just saw. But stretch that horizon out to a full year. what happens when you try to forecast volatility 252 trading days in advance?
The traditional VIX completely falls apart.
Oh.
Out of sample, VIX alone gives you a dismal 1.2% R squared. It is completely useless for forecasting one-year volatility.
Wow, 1.2%?
Yeah. SVIX alone gets you a bit higher, but when you use a joint model, when you use SVIX alongside VIX, the predictive power jumps to 10.1%.
Oh my God.
Yeah. SVIX adds a massive 9 percentage points of predictive power at the one-year horizon. That is a staggering improvement in robust, out-of-sample financial data. It's real and it's robust.
Okay, what is the mechanism driving that? Why does the VIX break down so badly at long horizons, and why does SVIX suddenly become this incredibly powerful tool?
What's fascinating here is if you consider the microphone analogy you used earlier.
The panic button.
Right. VIX's 1 over k squared weighting amplifies that panic button. At short horizons, like 30 days, the actual variance signal of the market is quite strong. The panic pricing from the lush tail doesn't drown out the useful information.
Okay.
But as you extend the horizon to a full year, predicting general variance naturally becomes much harder. The baseline signal just weakens.
But the noise from the panic button doesn't weaken.
Exactly the opposite. The premium that institutions pay for deep structural crash insurance a year out remains heavily priced into those options.
Ah, I see.
Large funds constantly buy one-year protective puts to hedge their portfolios, regardless of what current realized volatility looks like. It is a persistent structural bid.
So at 252 days, the VIX formula is actively amplifying that structural noise at the exact moment the actual variance signal is fading.
Yes, it becomes a noisy, contaminated forecaster.
And SVIX sidesteps this structural bid entirely.
Right, because it uses that flat weighting. It doesn't amplify the deep out-of-the-money puts. It just calmly records the whole room, allowing whatever actual variance signal is left to shine through.
Which is why it's such a triumph for the theory at that horizon. And you can actually see this in the spread between the two indices in the data.
Right, the gap.
Yeah, at a 30-day maturity, the gap between VIX and SVIX is only about 7%. But at 360 days, that correlation drops to 96%, and the gap widens to nearly 20%.
And that widening gap is literally the institutional left-tail noise creeping in and distorting the VIX.
That's incredible. Okay, so SVIX gives me a massive 9% edge in predicting volatility a year from now. So what does this all mean for you if you're actually trying to size a portfolio?
Well,
Like if I'm a systematic fund manager, do I just size up my long-term positions based on that clean signal to make more money?
you can't. And that is really the tragedy of the elegant model.
Why not?
The researchers tested portfolio strategies to see if trading on these signals generated better risk-adjusted returns, measuring it with the Sharpe ratio.
Right.
If you run a strategy that targets volatility using the traditional VIX, you get a Sharpe ratio of 0.501,
And the SVIX volatility targeting strategy.
0.496.
They're essentially tied.
Mm-hmm.
0.501 versus 0.496 is basically statistical noise.
Exactly. The maximum drawdowns are practically identical too, both around negative 36%.
But wait, we just established that SVIX adds this massive predictive power for long-term volatility. How does that not translate into a better Sharpe ratio for the portfolio?
The breakdown happens in the operational plumbing of institutional portfolios. Systematic portfolios don't size their positions based on what volatility might be a year from now.
Oh, because of risk limits.
Right. They are bound by daily risk limits, value-at-risk models, and strict capital constraints. To survive, they have to dynamically rebalance based on short-term signals, typically 30 days or less.
It's like having a weather app that perfectly predicts what the average climate will be next year, but you're a farmer who needs to know if it's going to rain on your crops tomorrow.
That's a perfect way to look at it.
Like if you size your crops based on the one-year climate forecast, a sudden storm tomorrow will bankrupt you. The long-term signal is brilliant, but it's operationally useless for your daily survival.
That is the exact bottleneck. At 30 days, where the portfolio is actually forced to rebalance, VIX and SVIX are 0.998 correlated.
They're the same thing.
Virtually identical. The long horizon improvement of SVIX is totally walled off from the daily reality of portfolio management. You cannot capture the benefit because your operational mechanism requires a short-term signal, and at the short end, SVIX adds precisely zero value.
Now, I do see in the data there is one SVIX strategy, the SVIX Sharpe target strategy, that actually hits a significantly higher Sharpe ratio of 0.744. On paper, that looks like a massive win.
It looks like a win until you look at how it achieves that number. To hit a 7.744 Sharpe ratio, the strategy requires an average leverage of just 0.316.
Meaning the strategy spends its time sitting in roughly 70% cash.
Exactly. It only generates a 4.49% annualized return over 3 decades. It is incredibly safe, minimizing volatility, but it is not a viable strategy for an institution trying to beat an equity benchmark.
Right, it's a mathematical artifact of the backtest.
It's not a tradable edge you can deploy at scale.
Okay, let's bring the bottom line into focus for episode 1 of this series. At 30 days, SVIX adds nothing. At long horizons, it offers genuine value for volatility forecasting. But for most trading desks out there, the traditional VIX is absolutely sufficient.
And this raises an important question about the ecosystem of financial research. You don't get published in top-tier journals by saying, hey, the old tool works fine.
Obviously not.
Academia fundamentally rewards novelty over utility. You get published by developing theoretically flawless models like SX. Ian Martin's logic is unassailable.
It really is.
But the market doesn't trade on flawless math. It trades on 30-day liquidity constraints. The practical payoff for someone in the trenches actually allocating capital is incredibly narrow. Simplicity often wins in the real world because simplicity doesn't overfit to the data.
The 1990s VIX is crude.
Yeah, the 1/k² weighting is a blunt instrument. But it is robust. It survives the transition from the whiteboard to the trading floor precisely because it captures the heavy-tailed reality of human panic.
That perfectly sets the stage for where we are going next. Because this horse race is only part 1 of our 3-part series on the limits of prediction.
Right.
In episode 2, we're going to look at the space between these two indices. Because mathematically, VIX squared actually equals SVIX squared plus a gap.
And that gap isn't just an accounting leftover. It explicitly isolates the higher moments of the option pricing surface.
Specifically, tail risk and skewness.
Exactly.
And the researchers tested whether that specific gap predicts market returns. And it does. Better than either VIX or SVIX alone.
It's amazing.
That isolated gap achieves an 8% out-of-sample R-squared for predicting returns at 126 days. Compare that to the 5.6% we discussed today for the VIX alone.
It is a genuinely surprising finding.
It suggests the predictive power of the market isn't found in this variance at all. It's found entirely in the tail risk. You will not want to miss that.
And then in episode 3, we ask the ultimate modern finance question. If 1/k² is a blunt instrument and flat weighting is too simple, can machine learning find a better kernel?
Right. Can elastic nets or splines beat the simple math from 1993?
The answer they found is deeply humbling.
So make sure you follow the show so you don't miss parts 2 and 3 of the option surface. But for now, I want to leave you with a final thought to mull over.
Let's hear it.
We just saw how a mathematically superior, highly sophisticated formula can barely edge out a crude 1990s equation when exposed to the real-world plumbing of the market. As you look across your own allocations, how many other highly complex, incredibly expensive financial products out there are really just beautiful academic illusions that add zero practical value to your portfolio? We'll see you next time for episode 2.